I'm George Soros. I've been investing for over 70 years and I'm worth about $7 billion. People often ask me what separates billionaire investors from everyone else. They want to know if it's intelligence, if it's connections, if it's access to secret information that regular people don't have. But the truth is much different than what most people think. It's not about being smarter than everyone else. Some of the smartest people I know are terrible investors. It's not about having more information. In today's world, everyone has access to the same data within seconds. And it's certainly not about luck, though I'll admit luck plays a role in any successful career. What separates billionaire investors from everyone else is how we think. It's our mental framework, the systematic way we process information, analyze situations, and make decisions under uncertainty. It's the lens through which we view markets, economies, and human behavior. I've spent 7 decades developing and refining this framework. It's guided me through every major decision of my career. When I made $1 billion betting against the British pound in 1992, I was using this framework. When I navigated the dot-com crash while others lost fortunes, I was thinking through this framework. When I positioned against the housing bubble years before it collapsed, this framework told me what to look for and how to act. But here's what most people don't understand. This framework isn't about predicting the future. It's not about being right all the time. In fact, it's quite the opposite. My framework is built around the assumption that I will be wrong frequently, that the future is unknowable, and that certainty is an illusion that destroys investors. The framework is about thinking in probabilities rather than certainties. It's about understanding the difference between what can be known and what cannot be known. It's about recognizing patterns in human behavior while remaining humble about the limits of that recognition. Most importantly, it's about making decisions that position you to benefit when you're right, while protecting you when you're wrong. Because the secret to building billions isn't being right all the time. And it's surviving long enough to compound the times you are right into extraordinary wealth. Today I'm going to share this mental framework with you exactly as I've developed it over 7 decades, not as theory, but as a practical system for thinking about markets, money, and opportunity in ways that can fundamentally change how you approach investing and wealth building. I'll show you how to think about uncertainty, how to process conflicting information, how to recognize when your own biases are clouding your judgment, and how to structure decisions so that being wrong doesn't destroy you, but being right changes everything. This isn't about copying my trades or following my positions. It's about adopting the mental processes that allow you to think independently, analyze objectively, and act decisively in a world full of uncertainty and complexity. Because once you understand how billionaire investors really think, you'll realize that the opportunities are everywhere. The question isn't whether they exist. The question is whether you have the mental framework to recognize them and the discipline to act on them when everyone else is paralyzed by doubt or blinded by consensus. Framework component 1. Embrace fallibility as your greatest strength. The foundation of my entire mental framework is something most people find uncomfortable. The absolute certainty that I will be wrong. Not sometimes, not occasionally, but frequently and significantly. This isn't pessimism. It's the most liberating and profitable realization you can have as an investor. Most people approach investing with the goal of being right. They want to pick winners, avoid losers, and have a high success rate. But this mindset is what keeps them poor. When you're focused on being right, you make small, safe bets that limit your upside. You become paralyzed by the fear of being wrong. My approach is completely different. I assume I'm wrong until proven otherwise. I assume my analysis is incomplete. My assumptions are flawed, and my predictions are probably inaccurate. This assumption forces me to structure every decision to survive being wrong while maximizing the benefit of being right. When I bet against the British pound in 1992, I didn't know with certainty that the Bank of England would fail to defend their currency. There were many scenarios where I could have lost everything, but I structured the trade so that if I was wrong, I would lose a manageable amount. If I was right, I could make billions. This fallibility framework changes everything. Instead of asking, will this work? I ask, what if this doesn't work? How much will I lose? Can I survive that loss? And if it does work, how much can I make? This single shift in thinking separates billionaire investors from everyone else. The practical application is that I never bet my entire net worth on any single idea, no matter how convinced I am. I never assume that past performance guarantees future results, and I never let ego prevent me from admitting when I'm wrong and changing course quickly. Framework component 2, understand that markets are mirrors, not windows. Most people think markets reflect reality, that stock prices simply mirror the underlying value of companies and economies. But I've learned that markets don't just reflect reality, they help create it. This is what I call reflexivity, and understanding it is crucial to thinking like a billionaire investor. When people become optimistic about a stock, they buy it, pushing the price higher. The higher price makes it easier for the company to raise capital, hire talent, and invest in growth. This actually makes the company more valuable, which justifies the higher stock price, which attracts more buyers, creating a self-reinforcing cycle. The same process works in reverse. When people become pessimistic, they sell, pushing prices lower. Lower prices make it harder for companies to raise capital, forcing them to cut costs and lay off employees. This makes them less valuable, justifying the lower price, creating a downward spiral. Understanding reflexivity allows you to spot opportunities before they become obvious to everyone else. During the early stages of reflexive trends, you can position with the trend. During the later stages, when reflexivity has pushed prices to unsustainable extremes, you can position against the trend. I used this framework during the 2008 financial crisis. I recognized that the housing market wasn't just overvalued, managed. It was caught in a reflexive bubble where rising prices were creating the conditions for their own continuation. When I saw signs that this reflexive process was becoming unstable, I positioned against housing years before the crash. The key insight is that markets are not passive observers of reality. They are active participants in creating reality. Once you understand this, you can anticipate how market movements will influence the fundamentals they're supposed to reflect. Framework component 3. Think in probabilities, not predictions. Billionaire investors don't make predictions. We make probability assessments. We don't ask what will happen. We ask what are the various things that could happen and what's the likelihood of each. This probabilistic thinking completely changes how you approach investments. Instead of looking for certainties that don't exist, you look for situations where the probabilities are skewed in your favor. Instead of trying to be right about specific outcomes, you position yourself to benefit from a range of favorable outcomes. When I analyze any situation, I create what I call scenario trees. I map out the various ways events could unfold, assign rough probabilities to each scenario, and then position accordingly. I'm not trying to predict which specific scenario will occur. Minus I'm positioning to benefit if any of several favorable scenarios occur while limiting my losses if unfavorable scenarios occur. During the Asian financial crisis of 1997, I didn't predict exactly which countries would be affected or exactly how the crisis would unfold, But I assessed that there was a high probability that the Asian development model was unsustainable, and I positioned against Asian currencies and markets accordingly. The probabilistic approach also means accepting that many of your positions will be wrong. If you're making bets based on 30% probabilities, you should expect to be wrong 70% of the time. But if your 30% bets generate 10 to 1 returns, while your wrong bets only cost you 1 to 1, you'll build enormous wealth over time. This framework forces you to focus on expected value rather than win rates. A strategy that wins 90% of the time but destroys you when it loses is inferior to a strategy that wins 30% of the time but generates massive returns when it wins. Framework component 4, develop systematic contrarian instincts. Billionaire investors make money by doing what others won't do. We buy when others are selling and sell when others are buying. But this isn't just about being different. It's about systematically identifying when crowd behavior creates opportunities. The crowd is wrong at major turning points because emotions override rational analysis. When everyone is optimistic, they push prices above reasonable valuations. When everyone is pessimistic, they push prices below reasonable valuations. These extremes create the best opportunities. But being contrarian isn't about automatically doing the opposite of what everyone else is doing. It's about recognizing when crowd behavior has reached unsustainable extremes and positioning accordingly while managing the risk that you're early. I use several indicators to identify these extremes. Media coverage is one minus when financial magazines are all featuring the same investment theme. When dinner conversations revolve around the same opportunity, sentiment may have reached extreme levels. Institutional positioning is another indicator. When hedge funds, pension funds, and other institutions are all positioned the same way, when cash levels are at historic extremes, when leverage ratios are unprecedented, these suggest that the positioning may be unsustainable. During the dot-com bubble, I recognized that technology sentiment had reached unprecedented extremes. Everyone believed internet stocks would rise forever. Traditional valuations were dismissed as irrelevant. This extreme sentiment created opportunity because everyone who wanted to buy had already bought, leaving few incremental buyers to push prices higher. The psychological challenge is that contrarian positioning feels wrong. You're buying what everyone hates and selling what everyone loves. But extremes exist precisely because they feel so compelling to most people. If buying at the bottom felt good, it wouldn't be the bottom. Framework component 5. Structure decisions for asymmetric outcomes. The final component of my framework is perhaps the most important, structuring every decision to create asymmetric risk-reward profiles. This means seeking opportunities where your potential gains significantly exceed your potential losses. Most people make symmetric bets. They risk $1 to make $1. But billionaire investors focus obsessively on asymmetric opportunities where they can risk $1 to potentially make $5, $10, or more. Even if these bets only work 20% or 30% of the time, the mathematics are compelling. This asymmetric thinking applies to every aspect of decision-making, not just individual trades. When I hire people, I look for individuals with asymmetric upside, people whose potential contribution could far exceed their cost. When I evaluate business opportunities, I focus on those with limited downside but unlimited upside potential. The key is that asymmetric opportunities usually exist in situations where conventional analysis suggests high risk, but careful analysis reveals limited downside with substantial upside potential. These situations occur during periods of maximum pessimism when everyone assumes the worst-case scenarios are inevitable. During the 2008 financial crisis, while everyone was focused on the risks of further deterioration, I identified asymmetric opportunities in financial stocks that had been oversold. The downside was limited because so much bad news was already priced in, but the upside was enormous if the financial system stabilized. Creating asymmetric outcomes also requires excellent timing and position sizing. You need to size positions large enough to benefit meaningfully when you're right, but small enough to survive when you're wrong. And you need to be prepared to act decisively when asymmetric opportunities present themselves. Putting the framework together. These 5 components work together to create a comprehensive mental framework for making investment decisions. Embracing fallibility keeps you humble and protects you from catastrophic errors. Understanding reflexivity helps you anticipate how markets will evolve. Probabilistic thinking helps you navigate uncertainty. Contrarian instincts help you spot opportunities others miss, and asymmetric structuring helps you compound small advantages into enormous gains over time. The framework isn't about being right more often than other people. It's about being wrong less catastrophically and being right more profitably. It's about surviving long enough to benefit from the natural tendency of markets to overshoot in both directions. After 7 decades of applying this framework, I can tell you that it works in every market environment because it's based on permanent features of human nature rather than temporary market conditions. People will always be driven by fear and greed. They will always swing between excessive optimism and excessive pessimism. They will always create reflexive processes that push markets to extremes. The framework gives you a systematic way to benefit from these permanent features of market behavior while protecting yourself from their potential negative consequences. It's not about predicting the future, it's about positioning yourself to benefit from the range of possible futures while surviving the ones that don't work in your favor. This is how billionaire investors really think, not as fortune tellers or market prophets, but as systematic decision makers who understand uncertainty, embrace fallibility, and structure their decisions to create extraordinary outcomes over time. Once you adopt this framework, you'll never look at markets, opportunities, or risk the same way again.